The Kochi-based healthcare services provider Aster DM Healthcare, which has listed at a discount to its issue price of 190 rupees per share. To talk more about the company's outlook going forward, Azad Moopen, Chairman of Aster DM Healthcare, joins us on the show. Mr. Moopen, thanks for joining us. Let me start by, asking you, removing the exceptional gain, if you see the last 2 financial years of the company has been reporting losses. Also for the first half of FY18, you have incurred a loss. When is this expected to change for the company, and when will the company turn profitable?
There is a reason why this has happened, and if you look at our last 10 years performance, it has been actually a very high CAGR of 25 to 30%, and the reason why there has been this last 2 years these challenges, it is due to the huge expansion which happened in the GCC. We setting up more clinics for catering to the requirement of the new insurance scheme which came up. So these clinics actually pulled down the profit significantly, and that's the reason why this happened in 2015-16. In 2016-17, there has been an exceptional situation in Saudi where there has been a write-off. So, but these 6 months, I must tell you that this is not abnormal. What is happening is that when you look at the GCC business, there is a seasonality. In the first 6 months, you will find that the business is only 40% and the profits are only 25%. This is so historically for the last 10, 15 or whatever number of years you are looking at. So projecting that what has happened in the earlier years, you will find that there is a much more profit to kick in the second half, and I am sure that as we declare the result, this will be obvious to the people, but I can't tell you what actually the position now is, but this has been historically what was happening in the last many years. So that's the reason why the 6 months you are finding a lower profit or lower, the EBITDAs and all.
Sir, keeping your bottom line aside, your revenue grew at a CAGR of almost 32% over the period FY13 to 17. Can investors expect the same run rate now going ahead?
Yeah, we expect anywhere between 20 to 25% growth as we go forward jointly from GCC and India, and we hope that this will definitely translate into profit. As I was telling you, we generally has been growing both top line and bottom line if you look at a little back, and so we hope that the business is poised for a good growth, both GCC and India, and we have now this plan of having about 30 to 35% of business being from India, and with the National Health Protection Scheme that has kicked in, that must even be much brighter in India. So we were thinking that this will be 30 to 35%, and that should also do well.
So, and this 30 to 35% revenue contribution coming in from India, by when can this happen?
So this will take about 3 to 5 years for us to have that 30 to 35% from India. But one thing which I want to tell you is that this is something which will happen gradually, but this period we will be able to do that. But when you look at the return on capital, this is comparatively lower in India. In GCC, the return on capital is higher because there is no capex for our business there. Very low capex for our business there because we don't own the real estate. Whereas when you come to India, it is mostly the real estate is owned. So that is the reason why there is a low capex, low return on capital invested. So we are trying to, have a hybrid of the good return on capital in GCC and whatever lower in India, and that will be a differentiator between us and our peer players.
Well, and let's also talk about your expansion plans. I believe you've got 10 more hospitals coming on stream, 5 in India and 5 in GCC. If you could tell us what sort of incremental revenue that you foresee from these 10 hospitals?
These 5 hospitals are likely to come in over a period of 5 years in India as well as in GCC. So as earlier I told, the overall growth projection, see, this is a small portion of our overall hospital or overall revenues, and whatever growth prospects which we see this will be part of that. So it takes time for hospitals to kick in and produce a significant revenue. But we already have many hospitals in pipeline which are in the ramping up stage. So together, whatever earlier I mentioned, we should be seeing that top line growth.
So, and among your three businesses, that is hospitals, clinics and pharmacies, which one is the most profitable for you?
There are two things. One, if you look at the EBITDA margins, the hospitals and clinics are actually more profitable, whereas the pharmacies are having a low EBITDA. But when you look at the return on capital employed, it will be actually better in pharmacies because the capex is much lower.
All right, sir. Thanks a lot for joining us today and taking us through what is in store going ahead for Aster DM. And remember, that's the new kid on the block. The listing has not been so great. The counter currently trades with cuts of nearly 6%.